Hello, this is Richard Riva with Wealth Management Solutions, where we provide the care, guidance, and course corrections for successful family business owners and their heirs that need an outsourced CFO to manage their financial affairs with purpose. That's our unique specialty. Today, we are talking with independent trustee Greg Reese at Reef Point about the collaborative efforts we put together to help their clients and tax advisors defer capital gains in the sale of highly appreciated assets. So I want to say welcome to Greg. Greg, I'm excited to hear more about the specialized strategy we provide our clients. Greg, can you tell me about this strategy and what we're doing for clients in this space?
Yeah, sure. Thanks for having me, Richard.
Great.
As you mentioned, I'm one of really a handful of trustees certified in this particular proprietary strategy. It's called the Deferred Sales Trust, and it's essentially a specialized form of an installment sale, which is a way for people to defer capital gains. So, installment sales have been around for more than 90 years. Pretty much a established part of the tax fabric, if you will, and scrupulously following IRC or Internal Revenue Code 453. And that's kind of the high level of what this is.
Interesting. Thank you. So this thing, the Deferred Sales Trust, tell me, how is it designed and maybe who is it designed for?
So, great question. You're like, who is this designed for? So a deferred sales trust is a strategy for primarily we're working with sellers of highly appreciated assets.
Okay.
Could be investment or residential real estate. It could be a business that you're looking to sell and exit from. It could be highly concentrated positions of stock for somebody who's involved in maybe one of the big tech companies and they've got millions of dollars or hundreds of thousands of dollars of stock. They may want to diversify but not pay all the taxes. Could be high value collectibles, artwork, et cetera. So it's really dealing in that space where you're looking to sell a highly appreciated asset. And to give you another kind of expanded flavor, we either work in the space of people looking for an exit strategy. I no longer want to be in what I'm in right now. If it's real estate, I'm tired of being involved in the management or what they like to call the tenants, toilets, and trash into the business, and they would like to move into maybe the clubs, cocktails, and cruises part of their lifestyle journey. Maybe they want to use the deferred sales trust strategy as an alternative to a 1031 exchange. What this could do for them, because it can accomplish essentially the same objective, except it allows the client to park their money and wait for the right opportunity and not just what presents itself in a very short window, which is what 1031 exchanges would be associated with. So it can be used as an alternative to acquire upside property after selling something else. And then the third lane really is a rescue for a failed or failing 1031 exchange. So nationwide statistics show that 1031 exchanges fail either partially or fully about 20 to 30% of the time nationally. When that happens, the taxpayer is going to recognize and pay taxes. So the deferred sales trust could actually be used as a backup strategy or a plan B, if you will, to allow them to still defer the taxes and then redeploy or reinvest their proceeds, not just in real estate, but in virtually any other investment category.
Interesting. Thank you for sharing that. So
Sure.
primarily, if you're in a real estate transaction and looking to do a 1031 and that blows up and somehow that process doesn't work well, this is used as a alternative or a backstop to that transaction. Am I hearing that right?
That's exactly right.
Okay. And if you're in a situation where you're in an exit strategy of a company, for example, you're holding low cost basis stock, either in a company or privately in an investment, and you've got a lot of appreciation, a lot of capital gains coming your way, you're not forced to just simply sell it at the market and pay the capital gains. You could use this strategy to avoid that or not really defer that into the future, right?
That's exactly right.
Okay. And so this is not a tax avoidance issue. Just to be clear, this is just a tax deferral strategy.
You're exactly right. Tax avoidance issues generally get you in trouble with the IRS. Tax deferral issues, if it's done correctly, they're completely fine with it. Look at IRAs. What is that? It's a tax deferral strategy, isn't it?
Right. Right. So deferring is not really a problem. It's just a matter of the structure. So I just feel that in some of our client situations where they have a real estate transaction or a business item or something they want to sell, they typically look to this is my only option, and that is to sell it and pay the tax. And so they don't sell it, they don't diversify, so on and so forth. In this, it gives you another tool that you can put in your quiver to say, hey, I could pull this out and use this as another strategy. But thinking about it in the terms of these types of transactions, is there a minimum where the maximum benefit is received in these structures? What kind of transaction should a client be looking at to make this worth their while?
Yeah, that's, what's great about this and what's difficult at the same time is a lot of the sellers that you're talking about, especially business owners,
Mhm.
they just don't know that there are other options available for them. So
Right,
by and large, they typically sell and pay their taxes.
right,
And they're often very disappointed because A, they typically didn't get as much for the business as they felt it was intrinsically worth. And
mhm,
then B, the second strike is getting hit with that tax bill because the basis is generally very low. It's like, how did most of the big tech companies start? With
right,
a basement or a garage and a phone and a computer, and then pretty soon it's worth some money, right? So
right,
the basis, the initial investment is very low, right? And then it's all profit. So
right.
understand that this is a legal strategy. It's a legal and tax strategy, legal proven and tested. So there are going to be some fees involved. And for this reason, a seller with a total anticipated gain of about $250,000 or more
Mm,
will realize a significant advantage using the
mm.
DST.
Okay.
Put another way,
Mm,
and this could vary depend on what state you live in, because this is a national federal based strategy under Internal Revenue Code, not under the state of California or Nevada or
mm.
Florida. It's federal code, so it applies to anybody anywhere in the country. But you
Okay.
may live in a state where your taxation is more or less than others, right?
Right.
So put another way, if at the close of your sale, without any particular planning, you would be subject to, let's say, $80 to $100,000 in total taxes
Wow.
as a result of that sale.
Yeah.
Then again, the DST could help you realize a significant advantage.
Now, it sounds as though I mean, so, well, the $250,000 minimum sort of gets you into the hurdle to where it's going to be beneficial. But you had said that it sounded like this has been around for a long time and that it's been somewhat tested. So I think there may be some viewers, pardon me, some viewers out there thinking this might be a little too good to be true. Could you talk a little bit about how the IRS sees this or how, if there's any audit exposure in these structures?
Sure. The one of the things about the deferred sales trust is that it's a proprietary strategy. So the term deferred sales trust is a trademark term to really kind of cover the strategy at large, including the types of trusts that are created, the types of transactional work that's done with the seller and their transactional parties on the deal itself. And it's a strategy that's not new by any means, but yet it's still new to a lot of people. And the primary reason for that, it is proprietary, and there's not 10,000 other tax attorneys in the country
Mm,
doing this.
mm,
The only reason there isn't, because some of them are smart enough to figure this out. However, what they haven't done is stood the test of time. They haven't been tested, they haven't been challenged, they haven't walked through the fire, so to speak. And that is the critical component of any tax strategy that anybody wants to employ, because people want to know, have you been audited? What was your results? Has the IRS talked to you personally? What were the results? Any of your peers, reviewed this independently? What were the results? Until you can build up that baseline of credibility, you don't have a lot to go on. So having said that, the Deferred Sales Trust was originally created by a CPA and tax attorney, an LLM by the name of Todd Campbell, and he's the principal founding attorney of Campbell Law. They're based in the Midwest,
mhm,
smack dab in the middle of the country,
mhm.
and for the last 24 years have successfully completed over 3,000 DST transactions, totaling well over $100 billion
Wow.
in sales transactions. They've had uh, a number, I think the number is 14 independent field audits with the IRS on individual trusts, which one of the good news about that is it's a very low audit rate because it's very much following specific code. not trying to mix and match different parts of the code, which the IRS often does not like, but
Right.
we're very focused on following 453 very specifically. So
Okay.
14 field audits, everyone with a no change letter, 4 different informal IRS reviews directly with us. The first one that came to pass was 2008, which was a 5 to 7 day invitation. You know how that goes with the IRS. Oh, and by the way, bring 10 years worth of every transaction record you have. So they did that, and the IRS found no problems, no deficiencies whatsoever. Sent it to Washington, D.C. for further review, did the same thing, no problems. And then there's been 2 subsequent follow-ups, because once they approve something, doesn't mean that they're just going to give you carte blanche to say you're going to be good forever, because they want to keep tabs on you to make sure you're not incorporating something new and different they might not like. So
Right.
we've gone through this a number of times. The last time was in April of 2019. And that was in a meeting with the head of the IRS office in Los Angeles. So the IRS is very well aware of what we do. They have inside knowledge, under the hood knowledge, because they've requested it, and we've given them absolutely everything they've asked for and had discussions face to face. Beyond that, FINRA, you're associated with FINRA. FINRA, oversees quasi-government private entity that oversees the operations of investment advisory companies around the country. They've had to take a deep look at this because people like yourself are helping to manage assets that are the result of some of these sales. And then finally, beyond that, some of the most highly prominent and known tax law firms in the country, which we can provide information on them, have done independent deep dives, signing NDAs with Campbell Law to independently verify whether they themselves felt that this was legal, proven, and tested, as well as hundreds of other smaller tax attorneys, CPAs, et cetera, have all taken deep dives. So
Okay.
awareness is growing, but it's not that unusual for people to not have heard of it still to this day.
Wow. So it's a very well vetted process and has had a great deal of success, but clients may not have heard of this simply because it's directed from this particular law firm and accounting firm. Do I have that right?
That's exactly right. Unlike a strategy for investment real estate owners called the 1031 exchange.
Mm-hmm.
Well, there's thousands of professionals involved in 1031 exchanges. Everybody knows about them because every attorney, can get into that. Every escrow company, every title company, every, QI, qualified intermediary. So there's thousands and thousands of people. So it's really well known. But guess what? 1031 exchanges have only been around half as long as installment sales under 453. We've been operating for 2 decades on a 90-year-old law.
Yeah. Interesting.
1031s have been operating for 45 years.
Right.
And they changed the law 10 years ago.
Wow.
So they limited the scope of 1031s, as many know, from being able to sell your jets and your yachts and your planes and all manner of assets, even artwork, to now it's real estate and real estate only.
Yeah, it sounds as though Campbell Law really wanted to take care of their clients and do a really great job in giving them an additional tax strategy. And it kind of got bigger than life and expanding throughout the country, but still very slowly expanding. So I think that's a nice insight for clients to consider, that even if they haven't heard of it before, it's not a, shall we say, under the table kind of scheme. It's a proven strategy. So maybe we should talk a little bit about how this transaction operates. And if, let's say, for example, someone had a highly appreciated asset and they go through this process, how does that process actually sell that asset? And then what happens to that cash for the seller and the buyer? What happens in that transaction?
Okay. Yeah. So let me walk you through that a little bit. So first of all, the strategy is based on 453, which defines and expands on what's known as an installment sale.
Okay.
And the definition of an installment sale is one in which you sell an appreciated asset, and some of your sales proceeds are not going to be received until 1 or more years beyond the year of the actual sale. If that's the case, that's by definition an installment sale. And the rules under the installment sale say that unless and until you actually receive the funds, you don't have to recognize or pay taxes on them. So you only recognize and pay taxes when you actually receive the funds. So if you sold a business or a piece of property, and let's say you received your sales proceeds over 5 years in equal installments, let's just say, you would only have to recognize and pay tax each year on what you receive, or 1/5 of the sales proceeds. It's not too dissimilar from how you tap into an IRA. You know, IRAs are tax deferred. You're not paying taxes as they grow. You only pay tax as you withdraw from it. And so, the key benefit there, and I'll kind of get into the mechanics, but the key benefit therefore is, number one, by deferring taxes on the sale, it allows you to keep that money in a trust working directly for your benefit, as opposed to having picked it up and transferred it to the government taxing authorities. Number two, if you agree to take your money more or less as needed and pay taxes as you go, you can often engineer the structure of your withdrawals, if you will, to put yourself into lower tax brackets.
Oh.
Because if I have to pay tax in the year of sale on the entire capital gain, I'm likely going to be at the maximum tax brackets around the horn, right? But if instead, if I take it in installments, I can reduce my tax brackets by often 10 to 15%, which is an additional tax savings. So having said that, with the installment sale, what happens is the seller is going to proceed with the normal process of selling their asset, whether it's hiring a business broker, M&A specialist, a real estate broker, to help them market and negotiate the terms of the sale.
Okay.
We come in with the seller prior to the close of that transaction. We work to create a trust for the seller's benefit. Our attorneys work with the seller and escrow, title, transaction attorneys, whoever is involved in the sale, to weave the DST structure into place. The client provides the trust with an option to purchase the asset just before the close at the seller's discretion. So as trustee, I may have an option to purchase your building, but you have to tell me if I can exercise the option. And you're going to do that just before the close. And then what's going to happen is you're going to sell your building, in this case, to the trust for the same price and terms that you've already negotiated with the ultimate buyer.
Okay.
You're going to receive an installment note as your consideration, meaning you're not going to get all the cash in your hands right now.
Right.
You're going to get a note equal to the amount that's coming from your buyer. The buyer's funds get deposited into a very secure bank account arrangement in your trust. And then and then we work out between us the payout structure that you're looking for.
Okay.
And it's essentially that. So it's not dissimilar from having a 1031 exchange involved.
Yeah.
As long as you don't have actual or constructive receipt of the money, you're not required to pay taxes that year. It's only when you receive distributions that you do.
Okay, so if I can just recap a little bit, maybe you could keep me on course here to make sure I've got this right.
Sure.
So if we're talking, let's say in this example, a real estate transaction, I've got this building, I'm going to sell the building. You could already have a buyer in mind, but if you simply put this DST process in the middle of that, then it somewhat captures that transaction for the client, removes this constructive receipt issue of the transaction. The transaction continues as it normally would. The buyer would utilize your escrow process. The seller would still see those proceeds placed in trust for them. And then they can decide how that distribution takes place according to an installment note. So do I have that right?
That's exactly right.
Okay.
Exactly
And
right.
so now the note holder is now the prior seller, right? The note holder has
Right.
this now deferred sales trust structure, and it's in that trust. And how does the note holder get paid or have received income from that? And what are their options in the sense of access to those income flows and ultimately the principal that they've put into this trust?
So great question, because it really leads to the types of control that the seller may have. So you paraphrased it perfectly in that the trust will receive the proceeds on your behalf, and as a result, you don't have to pay tax at that time. You and the trustee are going to discuss and create a contractual obligation, a promissory note, for the trust to pay you back that entire amount of principal plus a reasonable or hopefully an attractive rate of return over the period of time you want to use to draw it down. Your drawdown period could be, your note could be 1 year to 10 years initially. You'll pick the term that is most suitable for you. You also have the ability to accelerate the note term that you pick or extend it. So if you pick, let's say, the 10-year, but you want to have it all paid out to you, you decide along the way in 5 years, it's not a problem. No penalties for early withdrawal. If you like what tax deferral is doing for you and you're coming up to the end of your note, let's say it's 10 years, you can roll it over for another 3, 5, 7, another 10 if you want and keep going. Now that's the first bit that the client is going to control the payout structure, and we're going to put it in contract. There always have to be a contractual obligation that we're going to service, and it can be modified along the way, as long as the trustee and the seller both agree, which, there's not many, if any, circumstances where that's going to not make sense, unless it puts your transaction in jeopardy, and then we have to kind of figure out how not to let this be no longer in compliance, if you will. Beyond that, you talked about, well, what happens to the seller's money? Well, the seller's money, and we can talk about maybe protections later, but at the end of the day, the seller will determine how those proceeds are going to be reinvested in order to meet their income, wealth accumulation, or other goals. Whether it's to pay off some debt, put kids through college, pay for a wedding, generate income, grow their wealth. They're going to ultimately determine, working with us and a qualified investment advisor such as yourself, as to what are the appropriate investments that can be made, keeping in mind that there are really no limitations on the types of bona fide investments that you can consider.
Okay. All right. So if I understand that correctly, so the client has sold this building in this transaction. It's put in this protection, in my view, of the deferred sales trust that creates this constructive receipt separation. So they're not paying tax on the corpus. They get to choose a professional management of the cash and principal in there. So the entire transaction, whatever, let's say $1 million without having to pay taxes, gets invested in the portfolio. They use a professional process to manage that money. And then they can decide if they're taking interest income or if they're taking some portion of principal back or whatever the distributions are over that time frame from the trust. So all of that money is working for them and continues to work for them while it sits in the trust. By that right?
That's exactly right. With the flexibility to make modifications along the way, because there are so few strategies available to clients, which is what is so exciting about the Deferred Sales Trust, because all people know about, for the most part, are charitable remainder trusts and 1031 exchanges.
Right.
And that seems to be the universe of what's generally known. Well, 1031s only apply to real estate, and there's a lot of hoops you got to go through to be successful at that. Charitable trusts are like putting the sword in the stone, and only King Arthur can take it out. Unfortunately, you're not King Arthur. So it's locked down and you can't modify it. There's no flexibility in the future for you. And whatever you don't spend is going to charities, not your children. So that's a strategy for some, but not all, right? Here we have sort of a blend of the best of all worlds, which is why I'm always excited to kind of share it with people that have not heard about it before.
Yeah, that's fantastic. I really appreciate that. Now, we've talked a little bit about how the structure sets up, how that is operating for a client, what the protection measures are. Maybe you could talk a little bit about, and I'm sure our clients have the questions of what measures in this process are in there to protect them in that transaction. And then maybe we could wrap that up with what kind of costs the clients would experience with that. And then maybe we could wrap it up with the time remaining to say how they would get started if they're interested in more detail.
Sure. So as an organization, Campbell Law and the estate planning team, we have built and created a relationship with a large financial institution, SunWest Bank, a $19 billion banking institution, to serve as the repository for the initial funds from sale. The bank itself acts as an escrow agent of sorts. So the account, when you open up an account, you do an account agreement, the seller is a signer to that agreement, as is the trustee, as is the bank.
Hmm.
So the bank's role is sort of as, in addition to all the banking functions that you would expect,
Hmm.
the role is to act as a protector of the funds and an escrow agent of sorts, so that no money can be moved anywhere at any time without the joint written consent of the seller and the trustee as
Right.
verified by the bank.
Right.
If that doesn't happen in the correct fashion, the bank is liable for it.
Right.
So I joke with people sometimes, and everybody, this is a joke. I can never unilaterally use your money to build a new wing on my private island in the Fijian Islands. It can't happen.
Right.
But if it did, the bank's on the hook for that. So that's the first protection, right?
Okay.
The second protection really is that, for the most part, people that are approved to work and help become part of that team that's coming together with the client, your trustee, your investment advisor, we have to go through some pretty in-depth screening processes in order to be approved. So it's not like you're the only investment advisor in the world that could do this. I'm not the only trustee that there is, but we both have had to go through some pretty deep scrutiny, right?
Mhm.
And we agree to compliance oversight and all these kinds of things, which is great for the clients. Beyond that, once the funds are approved to be invested in a certain way, that's you and I and the client working together to figure out what really works for them.
Mhm.
Then we both sign an authorization verified by the bank to move that money to a financial custodian, such as Schwab, TD Ameritrade, Bank of New York, et cetera, which provides additional protections and security for the client's funds, right?
Right.
So they never really have to worry about anybody, making off with their funds,
So,
because we
so
have
this is
large financial
right. This
institutions
is not
protecting.
money that's sorry. This is not money that's going to you or to us, right? At
That
Wealth
never
Management
does,
Solutions.
never
This
does.
is another area in this transaction that the client sees in that timeline, that there's an escrow that protects them. Then that money is moved to a licensed custodian where the client has access to see those proceeds. There's professional management. There's oversight on those items. There's trustee fiduciary liability. There's bank liability coverage. So this is not just money done in a vacuum or some offshore structure that the client would, potentially feel uncomfortable with.
That's exactly right, and it's super important for people to realize that
Okay.
it's
So let's talk a little bit about what a client would expect. Obviously, this is not something that's done for free. The law firm and the accounting firm are doing this as part of the service to their firm, to their families. We're doing it as part of the service to our families. So let's talk a little bit about what the costs are. If there's anything up front, are there commission charges? How is that structured?
okay. Yeah, great question. And and we're very transparent about this because the fee structure is standard. It's very standard. Everybody around the country is pretty much looking at the same thing. So there are no upfront costs, number one.
Hmm.
Every case we work on, we do on a conditional basis, which means that when you actually sign, an agreement, that first agreement is a conditional engagement agreement with the law firm. They are now representing you legally for this transaction. There is no upfront cost. They only get paid if the transaction closes and you elect to use what we have built for you. If you
Hmm.
don't, we walk away. There is no charge whatsoever. So
Okay.
the legal and the setup charge from the legal side of things is typically between 1.25 and 1.5%. That's sort of the range, and it depends on what the value of the transaction is.
And
And
that's
it
a
could be
one-time
it's a
transactional cost?
one-time non-recurring fee, and
Okay.
something that's not always in play with most legal services, they provide audit defense protection at no additional cost. So
Forever.
if that trust is ever audited during the life of the trust, they will offer to represent you for free, no extra cost,
Hmm.
state court, federal court, IRS.
Wow.
Now, as I mentioned earlier, they've done this, you know, more than once, a number of times. They've never lost. They have incentive to represent you. Let's be honest, because they
Right.
want to keep the perfect track record running perfect, as well as protect you, their clients. So,
Okay.
but that's an inherent part of the one-time non-recurring setup cost. And then on an ongoing basis, you'll have somebody like myself as trustee. You'll have somebody like yourself, Richard,
Mhm.
as investment advisor. And the best way to describe this in sort of the short time we have is our fees combined, all in, creating a tax return for the trust at the end of the year, the bank service charges, the wealth advisory, and the trustee, all of that, about 1.1 to 1.5% per year, or less, depending on the value of the transaction that you have, which is incredible when you think that a lot of investment advisors charge that just on their own. A lot of trustees charge that fee just on their own. But we're all in at that fee. And for what it's worth, the expectation is that the investments and that the client approves are expected to perform net at the rate of return that they're seeking, net of the fees that we earn for our services.
Right.
So there you go.
Right. Okay, that's great. Thank you very much. So no hidden fees, no commissionable charges, a setup fee, and an ongoing management that clients in the world of professional management of money would experience at any case. So it doesn't sound like there's any additional, or shall we say, I don't want to say hidden, but additional costs that would be unexpected in the management or professional management of money, especially with a active fiduciary, trustee, and advisor involved, right?
Well, that's right, and we're very, very transparent with every client. You mentioned earlier if funds are at TD Ameritrade or Schwab, and then you're managing them, for example,
Right.
they have access to the statements too.
Right.
We also provide additional quarterly reports and have quarterly review meetings with each and every client.
Right.
So we do summaries every quarter, but they have access to every monthly statement or to see it at any given time. So so they can see everything that's going on at all times. So
that's a very good point. And as the advisor on these cases, we too are meeting with clients on a regular basis, reviewing and conducting these sessions with clients so that they're fully informed. So I think that's really, really critical. Well, I know we've got to wrap up here, but I wanted to ask Greg, how do folks get started with this? How do they learn more? How do they get the ball rolling if they're interested in learning more about this process?
Well, I think I think at the conclusion of this webinar, there's going to be a slide or a screen. There's going to be some contact information there, and even a link if you want to go in, if you have your own transaction, or you want to kind of get an illustration, you want to see a sample. There'll be a link for you to actually put in some of the information about your own particular potential sale, and we can provide an illustration for you. But other than that, phone numbers, emails, contact information will be right there. So, jot that down, or this will be posted so you can always revisit it.
Yeah,
and
reach out to
Richard,
us.
I thank you for having me on today. It's been a pleasure talking to you and hopefully educating some more folks that are saying, I never heard of this before either. So this is great.
That's fantastic. I really appreciate your time today, Greg. It's really great to see you again. We love working with you. We love taking care of our clients and taking care of these tax deferral opportunities as a strategy to helping them with their overall management of their wealth. So we really appreciate it today. Thank you for taking the time.
You're welcome, Richard. Thank you and have a great day.
Thank you very much. Bye-bye now.
Bye-bye.